Now, this weak economic performance impacted on the asset quality in the banking sector. And we have seen that we ended last year not only with slower growth, but with very high non-performing loans, for which the central bank had to organize the asset quality review in order to properly assess what the impact of those loans are on the capital levels of the banks. This year, we've had a new government in place with a new policy agenda with a stronger focus on macroeconomic stability, which we expect would help us increase the levels of growth. The following charts gives you a sense of what has happened in terms of the persistent slowdown in the growth rates, going down from as high as 9.3 to 3.5% this year. In terms of the exchange rate, you would also see the very high rates of depreciation that we recorded in 2014. And then the inflation experience also shows the rise in inflation rates between 2012 to 2015, as well as how all of that has impacted on the non-performing loans ratio, rising to as high as 21.2% in June 2017. The next graph shows you the monetary policy rate and the lending rates and how these have evolved over the last 4 years, with the monetary policy rate rising to 2015 and only beginning to come down in 2016. And then you can see how the lending rates have also trended. Now, the impact of these rates, of course, have been on the private sector credit growth, which has come down significantly over the last 4 years. And in real terms, you'll see that private sector credit growth was negative in 2016. So the macro developments, the slowdown in the economy did impact on bank profitability, bank credit. As you can see, bank credit to the private sector in Ghana as a proportion of GDP is relatively low compared to what you will see in other peer countries, Kenya at 34.8%, Botswana at 33.8%, and Ghana is only at 19.4%. I think the essence of this graph is to suggest that there is a lot of room for financial intermediation in Ghana, increasing the depth of finances. The next graph shows the behavior of bank profitability over this period. As you can see, peaking in 2014, we've seen the return on equity on the sector go down significantly. Now, the results of the asset quality review showed that a lot of the banks were not provisioning appropriately, and asking them to do the necessary provisioning led to some capital shortfalls by some of the banks. As you can see, we have one bank that has even a negative capital there. So broadly, the macro story to all of this is what the impact of high rates of inflation and high currency depreciation does to the capital base of banks. If you look at the history of minimum capital requirements in Ghana, you would see that in 2002, we had a differentiated capital requirement, with domestic banks being asked to have a minimum capital of 2.5 million, foreign banks a minimum capital of 5 million, and then you had the development banks with a 7 million minimum capital requirement. In 2003, we introduced the concept of universal banking, where all banks were required to have a minimum capital of 7 million. This was raised to 60 million in 2008, and then in 2013, this was raised again to 120 million. In US dollar terms, as you can see in the lower panel of that table, is what had happened to the US dollar value of the minimum capital requirements, starting from almost $61.5 million in 2008. The current level of the minimum capital requirements puts us as just $27.9 million. So there has been a significant capital erosion in US dollars, partly because of the instability that we have seen in the economy, manifesting itself in high rates of inflation and high rates of depreciation. The following graph shows you where the banks are in terms of the various bank capital. As you can see, with the minimum capital of 60 million, almost all of them are covered, just around 120 million, and then you would end up with banks below, on the right of Premier Bank, not being able to meet the 120 million. So this is the situation as it is. A lot of the banks are still at the minimum capital levels that were set in 2008 at 60 million. And as a result of that, you see that the capital base as a percentage of our GDP ratio has declined consistently since 2013. All of these provide the evidence on why we need to go up on the new minimum capital for the banks. Well, we are looking in the next table at some of the high-value transactions that the banks have had to come to the Bank of Ghana to obtain waivers because of the single obligor limits. You would see that some of these transactions include oil and gas transactions, customers such as Tema Oil Refinery. You have customers such as the Volta River Authority, United Steel, WOST, ECG, ports and harbors. These are clients that engage in fairly high-value transactions for which the banks have had to obtain single obligor waivers from the central bank in order to be able to finance these types of transactions. So, I think one has to look at the agenda of the government, the issue of trying to sustain the macroeconomic and debt sustainability. The policy focus for this year is to try to drive inflation into single digits with the high levels of debt that we have inherited. The objective is fiscal consolidation and reprofiling the debt structure. Second prong of that agenda is to improve the business environment through the tax incentives that were introduced in the budget, increase investments in infrastructure, and then leverage on the oil and gas resources to create a robust job-creating manufacturing sector. Not forgetting the importance of social inclusion, and in particular, the national identification system, which is a key architecture needed for financial services. We know what the macro projections are for 2017. We are looking at a 6.3% growth rate, non-oil of 4.6%. The projection is for 7% growth in the medium term. Objective for a single-digit inflation over the medium term. Budget deficit of about 3%. And the argument is for fiscal responsibility law that will set the budget deficit at around 5%, and then to ensure that we have foreign exchange reserves that are higher than at least covering at least 3.5 months of the import cover. There is no doubt in our mind that returning the economy to the higher growth path would require that we have stronger banks that would support stronger transactions in the economy. The expectations for output over 2017 and 2018 is to see strong investment flows which would support our revenue growth. We're expecting oil production of around 123,000 barrels per day from 89,000 in 2016. And as you know, the first quarter of this year, we've seen annual quarterly growth rates of 6.6% already, suggesting that the real economy is beginning to pick up. As you know, our monetary policy stance this year has been on the easing side. We've come down at the last MPC meeting by 150 basis points, adding to the 100 basis points that we had done earlier on in the year. And this is in support of the inflation easing cycle that we have seen since the beginning of the year, taking place on both the food and the non-food inflation processes. The underlying inflation pressures are also moderating, which is providing a strong support for our monetary policy easing. And then our surveys of businesses and consumers also suggest that we are seeing inflation expectations also declining. So the next graph shows you what the projections show. As I said earlier on, we are on track to deliver on the single-digit inflation target by early next year. On the external side, we are seeing that, yes, the current account has improved from nearly 11.7% of GDP in 2013. First quarter 2017 numbers suggest that we are seeing a current account surplus. The improvement in the current account has helped increase the reserves of the central bank, which is also helping to support stability in our foreign exchange market. And as you know, the pace of depreciation has slowed down, given the higher levels of gross international reserves at about $6.4 billion US. That is 3.8 months of import cover in half year 2017. On the regulatory side, the legal framework for banking sector supervision has been strengthened with the introduction of the Banks and XDI Act. We also have the Ghana Deposit Protection Corporation Act, which has also been passed. And then there is a comprehensive action plan to improve supervision and enforce the prudential rules and strengthen the soundness of individual institutions in the microfinance sector. As you know, the Bank of Ghana supervision function is handled by 4 departments: the Banking Supervision Department, as well as the Other Financial Institutions Department. We also have the Financial Stability Department, and then the Payment Systems Department, which is responsible for the supervision of payment systems infrastructure. The bank has aligned its regulatory framework to reflect the changing complexities that we have seen in the industry, as well as to adopt the international good practices. And as you know, the new Banking Amendment Act has several new clauses with a view to enhancing the robustness and adaptability of the regulatory framework. The Deposit Protection Act, for example, seeks to protect small vulnerable savers and help build confidence in the banking system. The bank is also building a financial consumer protection framework for Ghana in collaboration with the German Development Corporation. And the work plan for the development of the financial consumer protection regulations for digital financial services has also been adopted. In addition to all of this, the bank has also introduced a new set of liquidity monitoring report templates to help improve the monitoring of liquidity management processes in the industry. Last but not the least are the preparations that are being made for the adoption of the Basel II, Basel III capital framework by the middle of next year. So, ladies and gentlemen, this is broadly the background to the discussions on the need to increase the capital requirements for the banks. The new policies are committed to the medium-term program to stabilize the economy, to improve the business environment, We think that the early signs are that we are making a lot of progress. There is broad private sector participation in the economy, which should propel the growth and development agenda. And banks are expected to take advantage of this new policy framework in terms of the improved macro to support the growth agenda of the government. Given the size of transactions that we are seeing in the economy, it's important that we strengthen the capacity of our banks. Secondly is the issue of high non-performing loans in the banking system, that we want to ensure that we address the causes of the high non-performing loans. That is the only way in which we can guarantee that additional capital to the banks would lead to additional lending. Otherwise, if we are still going to be converting those new capital into non-performing loans, then we are not going to be achieving the objective. Key is the importance of macroeconomic stability. The need for recapitalization in the banks, as I showed you since 2008, has been due to the high level of macro instability that we have seen, which is at the root of the erosion of the capital base of the banks. We cannot afford a cycle of high inflation, high exchange rate depreciation, recapitalization of the banks, which is not sustained, and then you get into another vicious cycle of macroeconomic instability, which leads to further needs for future recapitalization. Let me assure you that whatever decision that we make on the new level of capitalization, it would be accompanied by procedures for enforcement. We are not just going to announce a minimum capital requirement which will not be enforced. This has been the practice in the past. New capital requirements are announced. The banks are given a 2-year period to meet the requirements, and they never really meet it. In fact, the 120 million that was last announced was supposed to be for new entrants. And the bank has not really clarified what that level of capitalization means for banks that were already existing. We are not going to have that happening going forward. Once we announce the new capital requirements, this will be accompanied by measures of enforcement. And we will do this in a very orderly manner. We are not going to see any disorderly consolidation in Ghana if this is the way that we have to go. I'd like to end here and thank you all for listening. Thank you.